Well, good morning. This is Dean Tenney. I'm coming to you from my studio here in fabulous Las Vegas. Um, we're coming up on just a few days short of the anniversary of the channel. The YouTube channel was one of my New Year's resolutions from the beginning of this year. My original goal was to publish, a lecture once a week, and that would have put us at 52 lectures for the year, and we're close to 100. So we have posted a lot more content than that original plan. But this will be it for the year. So enjoy your holidays, and we'll be back in 2022. And I'll try and come up with a more regular kind of a publishing schedule, something that can be sustained longer term. If you are taking your NASA exam, that means you're typically at the end of your testing journey, but no test taker left behind. So if you would be as kind enough to share the channel with those who might be behind you in their testing journey, either on starting their NASA exam prep, or even starting their SIE or doing their 6 or 7 top off, share the channel. We have playlists for them as well. All right, so today, continuing the explication, we're going to do D, portfolio management strategy, styles, and techniques. Again, I highly recommend that you print the PDF that NASA provides on the test specifications. You can follow along and use this as your intellectual inventory as you go through your study materials. Maybe use plus minus, like plus means I got it, minus means I need to go back into my study materials and do some more work. And like I say, 5 or 6 years. So strategy, strategic asset allocation. So strategic means, let me get my thing going here. Strategic means longer term, and we associate strategic with passive investment styles. And, there's advantages and disadvantages to all different kinds of investment styles. And the advantage to being strategic and being more buy and hold, for example, I'm not saying we're going to hold forever. In bonds, for example, I would tell my customers we are going to buy and hold the bonds to maturity, reduce the volatility, because, we're not participating in the secondary market. We don't have to, worry about interest rates and bond volatility. Remember that from previous things, duration, that kind of thing. But anyways, we're doing more of that. And since we're going to be doing more of that in this style of investing, we're going to have lower trading costs. And that means we're going to have typically more tax efficiency. The capital gains tax, whether it's short-term or long-term, is a transaction-based tax. And the easiest way not to pay it is not to transact. And so in strategic asset allocation, we're not typically going to be doing as many transactions. We may rebalance the portfolio for asset allocation. That's still a passive strategy. If we have, like, for example, 60-40 thing, so there will be transactions, but it'll certainly be a lot less than would be tactical asset allocation. Tactical asset allocation is typically more focused on, let's get my thing here working, active management. And nothing wrong with active. I mean, well, nothing wrong again, but it's not wrong, good or bad. It's just what it is, right? So in tactical asset allocation, we typically think of this as shorter term. And here we are going to have higher trading costs. And it may not be as tax efficient, because there's going to be more tax consequences. I'll put it that way, more tax consequences, because we're not actually paying the manager of, who's actively managing things, whether it's me as your investment advisor rep, or, we're using a mutual fund to think of our personal tax return. So we're going to have more tax consequences to that as well. So we said active, passive. We said tactical is considered to be active. Passive is considered to be more strategic. So I'm on this next one. Growth. If I'm a growth manager, let's get that separated here. If I'm a growth manager and I'm looking for opportunities in growth stocks, I'm typically going to be looking for, let me get going here, get my I'm typically be looking for stocks that have, let's see here. Again, what I'm trying to do in the explications is put my comments in a different color, so you can tell what are the comments that are coming from, this state administrators, what are coming from Dean. Here, if I'm looking for growth, now typically if I'm looking for growth stocks, I'm looking for stocks that typically are going to pay little or no dividends because we want them to build the business. We're into this for price appreciation. So we expect them to, keep whatever earnings they have and reinvest them into the business. So here we would typically have a higher PE ratio for these kind of opportunities. We would be looking for price appreciation. The only two ways you're going to make money in investment is through income and or price appreciation. So if there's no income, if there's little or no dividend, the way we're going to make money is, buying low and selling high, right? Price appreciation. If we're going to hold it and be at risk for more than 12 months, what would be the, assumption we would have? Maybe we're after here at capital gains, long-term capital gains. That may not be true depending on, how actively, how active somebody is in buying and selling the securities, right? But for, our purposes, I think that's a safe kind of an assumption. So we would want them to be able to grow, independent perhaps of the economy. Now with value, we would be looking for typically companies that would have perhaps dividends, a good, nice, juicy dividend, perhaps to provide us with an income stream. Perhaps we'd be looking for stocks based on a balance sheet and, doing fundamental analysis that we've talked about earlier, maybe a low price to book in terms of value of a good stock. Maybe we're looking for companies with lower PEs. Typically what we're going to, ask you to do if you get this, I told you there's 5 or 6 questions in this area of your exam. What we're typically going to ask you to do is contrast growth and value, the different styles, right, of what you're doing. So if I'm going for value, that's what I'd typically be looking for. And, I wouldn't be concerned with like book value. I mean, in a growth stock, that's a kind of a stupid thing. Well, I shouldn't say stupid, but not something we're looking at valuation. Now in income, remember this could be both bonds or stocks that we would be investing for. And this ties into all those other investment vehicles we've discussed, like, bonds, whether they be corporate bonds or muni bonds or government bonds, and preferred stocks, perhaps stocks with dividends. Don't forget that preferred stocks are fixed income investment vehicles. So, common stock may or may not have a cash dividend, but preferred stock certainly does. So, when we're talking about fixed income investment vehicles, remember preferred stock is one of those. And we talked about capital appreciation in terms of what we're trying to do in terms of grow the portfolio, right? We hope the portfolio has a higher value down the road. Diversification is huge in terms of diversification. Let's get that going. Again, I'm using the 66 PDF, but your 65 is the exact same content. As I've said over and over again, when it's not the same content, I do separate explications. When it's the exact same content, I use the 66 document. The only distinction in the content on the 65 and 66 here is that the 66 has 5 questions in this area, and the series 66 has 6 questions in this area. So, and then I'm putting them in the separate playlist because I do know it gets aggravating when everybody's trying to tell you to 60. This is for both 65, 66. So if it's in your 66 playlist or your 65 playlist, you series 65s, it's for you. And it's the exact same document in terms of you're following along. You could go to the section here and you'll find it's the exact same as what I'm talking about. All right, so diversification is used to avoid selection risk. And remember, we say a selection risk is also known as systematic risk. And so that would be a smart thing to do, right? In a portfolio, key element, particularly under modern portfolio theory, is this idea of diversification. Now, sector rotation, one other test question about this idea of non-systematic risk. You're still going to be exposed to systematic risk. So systematic risk is going to prevail despite your diversification, and that too is testable. Now, sector rotation is where we buy and sell based on the business cycle. And boy, this has been really challenging during the pandemic. People think, okay, if I'm practicing sector rotation, that, for example, when we enter the pandemic, Dean, gets out of the hospitality stocks and gets into defensive stocks, things that I think will do well during the pandemic. And once we come out of that we had a recession, 2 calendar quarters, come back out, that I redeploy based on what sectors I think are going to do best based on the business cycle starting up again. And then again, the problem here is, the pandemic has caused starts and stops in terms of sector rotation practitioners, where they rotated and we're not quite back out. But sector rotation bases asset allocation based on the business cycle. Okay, so dollar cost averaging. Dollar cost averaging has 3 components that make it work. And the 3 things that make dollar cost averaging work are fixed dollars invested regularly, so what you're going to do is agree to invest a fixed number of dollars every month or every quarter, whatever the case may be. What will be the end result of dollar cost averaging? You'll end up with a lower average cost than those of the underlying shares. And then, we never use this nasty word, that doesn't guarantee a profit. Doesn't guarantee a profit. You'd be hard pressed to convince me that over any lengthy period of time, as somebody's dollar cost averaging, that it's not going to work out. More people get where they're going without crashing and burning using dollar cost averaging, because you're combining a savings discipline with some investment risk in a good way, right? By doing fixed dollars invested regularly, you're going to end up buying less shares when they're expensive and buying more shares when they're cheap, which is exactly what you should be doing. So whether it's a mutual fund, that would be the best way to kind of use this strategy, or whether it's securities or feeding your portfolio. I'm your investment advisor rep and you agree to put 25 grand into the portfolio every quarter, whatever the case may be. Now remember, if we are buying stocks or mutual fund shares over time, in terms of the tax consequences, when I turn the investments back into money, we can use FIFO, first shares bought or first share selling. We can use share identification, or we can use average cost. And remember, if we don't keep good records, the IRS is going to impose upon us, FIFO. Okay, so options. I kind of ranted last time on options, and I'm not so sure what I want to tell you about options. There are 2 types of contracts, as you see here, puts and calls. And what I always tell people is I think it's really more about the answer set. It's really more about the answer set than it is, trying to, buy a call or go long a call. What that is a choice to buy the stock. And you wouldn't want to have a choice to buy the stock unless you were bullish. Sell a call or short a call. So it's primarily how this answer set is going to play out as a test issue. I'm not going to put a short put there because I can't imagine in a NAS exam where the short put would be a potential answer that's correct. So I'm just going to leave that one out of there, even though that would be the D choice, and tell you that I wouldn't worry about that as a test issue. Now, there's two things I'm going to be using options for, puts and calls. I'm either going to be using them to hedge. Hedge means offset risk. And what we mean by that is I might be using them for volatility management. And what that means is if I have a stock position, I'm either going to have a long stock position, and we're going to add an option position to it, or I'm going to be speculating, using the options to provide leverage, making a little money do a lot. And so let's look at the first example of this. So let's say that I'm long the stock. Now that long just means, again, it looks like I'm not being consistent here. Let me go back and change that. Buy is synonymous with long and sell is synonymous with short. So, but the two stock positions we have is a long stock position. And what I'm going to do here, if I'm using options in the portfolio on a long stock position, I could also hedge the entire portfolio using, index options or VIX options or whatever, bond portfolio yield-based options, but, they don't really go into that kind of depth on the NAS exams. Anyways, this is going to be a long stock plus an option. And for protection, there's going to be two scenarios, protection or income. And if what they are looking for is protection on the exam, I'm going to say A, buy a call. Excuse me, long stock. I'm going to say C. Like it doesn't want me to. We're going to do C, buy a put. We're going to establish the choice to sell. And that'll put a floor on that. Let me get a different color here. What a put is a choice to sell. So once you know that you are going to protect, you got a 50-50 chance based on that answer set. And what that put does is gives you the ability to participate in a big price increase, but not participate in a big price decline. Now, the other thing we could do is let me get my color back here. Let's see, it'll let me do it this time. We could do B. The other thing we could do is B, we could generate additional income by selling a call. And that would give us, let's get a different color here. That would give us an obligation to sell stock we own, which is much different than we're going to sell stock we don't own. And the reason we do that is to generate additional income. So I mentioned it's that answer set that is most important, A, B, C. and picking the right, one of those based on, remember this whole area is 5 questions for 66, 6 questions for 65. Okay, so for protection, you're going to buy. That gave you 50-50. And for income, you only got one that works because we're not going to ask you about income on short stock positions. So it's just B. So, maybe you're going to use flashcards instead of learn options. You want to learn options? There's 12 hours of lectures in the channel on options. So the other position I can have is a short stock position. That's selling borrowed stock. That's selling stock I don't own. And again, the only question here is going to be protection. Because if I short the stock and I don't have any protection, I'm going to have potential unlimited losses. And so it would behoove me to take action using options. And so again, let me get a different color. So the answer here is going to be A, buy a call. And that puts in a ceiling because that is a choice to buy back the borrowed stock at a set price, that's a strike price, at any time, that's American style expiration. And most important is as a practitioner, what I've done here, but wow. Borrowed. They're like I say, this is free form, so don't hold me accountable for spelling and grammar. Anyways, between now and expiration of wherever that protection is. So here, short stock, what this has done, let's get a different color, is what I've actually done here is I have changed the short stock position from unlimited risk to limited risk. And that's pretty cool. That is pretty cool. All right, so let's see. So use of put and calls. I think it's more likely that you're going to get the puts and the calls as hedging transactions than leveraging. But the two major ways we leverage investments in a portfolio is with buying options. Back to this. And margin. Leverage is making a little money do a lot. Leverage is about financial speed. And the big point here is the same supercharged speed you're going to make money with is going to be the same supercharged speed you're going to lose money with. Right. So there's leverage worth in both directions. Again, this is not a lecture on options. There's hours of it, but I'll just give you an example. If I buy 1,000 shares of Apple at 165, that's $165,000. And if Apple goes to 185, I've made $20,000. And if we took the 20 and divide by 165, that's a good return. But if I buy an Apple 165 call for 10 and Apple goes to 185, the contract I paid 10 for at 185 is worth 20. I've doubled my money. So that's 100% return. So that's why I would use the option perhaps. Now I'm not going to go into the, that's unlikely because if I buy the stock, I only have to be right about one thing. Now, again, if I buy 1,000 shares of Apple 165 and it remains unchanged, I haven't lost any money. But if I buy a 165 call with Apple at 165 and it remains unchanged, I lost the entire 10 points on 10 contracts. That's $10,000. So again, I'm illustrating this idea that we're making money twice as fast. We're going to lose money. Well, in options, even more than twice as fast. Now in margin, I'm using borrowed money to purchase securities. And so if I buy 1,000 shares at 40, I put up 20 and the stock goes to 50. I bought the stock $40,000, 1,040. I made 10 grand. 10 grand divided by 40 is 25%. That's a great return. But I do that in my margin account. I put up 20 to buy the 40 and I made 10, I made 50%. I'm making money twice as fast. But again, if the stock goes down, I'm going to get wiped out. Well, I shouldn't have wiped out, but I'm going to lose money twice as fast as well. So we said volatility management, we can use options for that. Or we can reduce exposure, right? I was just reading this morning where, a hedge fund manager said he's reducing his exposure. The volatility has been too much. They've been losing too much money. And so he's reducing the exposure to those securities that are causing the volatility in the portfolio. This is a letter to his partners in his hedge fund. So, we can use options. As we mentioned, if we want to reduce the volatility on a stock, we could, buy a put or reduce the volatility in the short stock position, buy a call. But we also could just reduce the exposure to that particular investment within the portfolio by selling it. Okay, well, I hope you're finding these explications. This is a shout out to Lori. I don't really try and match the publishing schedule to people testing. But if you're a loyal subscriber and you find them productive and you say, Dean, see you've stopped in the explication, could you start back up? I will sometimes use that as an excuse to get my butt in gear and get some more of this stuff published. I'm trying to finish up 65, 66. Again, this is the exact same content. Please, if you're 65, do not start telling me, oh, Dean, it says 66. It's the same thing. If you print the document, you'll see it's the exact same thing. I'm just putting it in a playlist. I'm putting it in both playlists separately. So you're not fumbling around with, is this for me or not for me? It's for you. And then when it's not the same document, when it departs from being the same document, then I do it separately. So we're not explicating anything that we're trying to make it work for both exams. We're explicating content. All right. Well, like, share, subscribe. I'm hoping to get 3,000 subscribers by the anniversary. I think I'm going to miss it a little bit. I'm closing in on it as we speak, but it looks like I may not make it. My other goal was 200,000 views by the first year, and we preponed that. We got there early. We did that about a week ago. So the remaining goal for the channel would be those 3,000 subscribers. So as I mentioned, circle back to your folks who are in the testing journey somewhere behind you and let them know about the channel. Like, share, subscribe, and I'll see you next time.